In this presentation, I will be introducing the Weekly Reversion Strategy. It is an active stock picking strategy aiming to generate higher than 20% annualized returns. And it's a good alternative to buying and holding an index fund because it aims to exceed the S&P 500 returns by a good margin and produce less than half of the drawdown of the S&P 500. And it's also designed to be a relatively low maintenance strategy in order for subscribers to be able to execute it with minimal effort. All it does is it calculates the stock picks on Sunday night, and the subscribers may input those positions into their accounts on Monday morning and then exit on Friday. So it's, I would say, relatively low effort for competitive returns. What it does is it ranks and selects up to 5 US large cap stocks that have recently sold off. These stocks need to be showing technical weakness in the near term, but need to be able to snap back upwards in the near term as well, so in the following week. This is what is known as buying the dip or mean reversion. So how does this work? Every weekend it computes indicators across all the stocks in the S&P 100 index. This is also known as the OEX index, and it consists of the largest 100 stocks by market cap in the S&P 500. It's an interesting thing to note that these 100 stocks also have options on them. So if anybody's an options trader, the strategy could potentially be traded using options. However, I'm not really intending for it to be used that way. This is primarily a stock picking strategy. So it selects up to 5 candidates, and it buys on Monday's open and exits on Friday's close. It does not hold any positions over the weekend. Because we're buying dips, we want to avoid additional volatility that could be there over the weekend. And the strategy does not make use of any stop losses or profit targets. Each position is given an allocation of up to 20%. Sometimes there may be fewer than 5 stocks because of a lack of candidates meeting the entry criteria. And the exposure to any given stock may be less than 20%. This can happen for a couple of reasons. A, the stock may be extremely volatile, in which case we want to be less exposed. And B, there is a regime filter in the strategy which looks at the trend in the OEX index. If that trend is pointing downwards, then there will be less exposure given to all of the stocks in the portfolio. So here we have the backtest of the strategy. This is a 30-year backtest going from Jan 1994 all the way to May 2024. And it is a backtest that is free of survivorship bias. What survivorship bias is, it's when you do a backtest of a current snapshot of a stock universe and use that static universe going all the way back in history. This backtest is not like that. It's free of survivorship bias, so it uses all the stocks that were in the S&P 100 index throughout history. So in this backtest, you're going to see stocks, for example, such as Lehman Brothers and Enron included in there. And also the index constituents, in other words, the universe composition of the S&P 100 is true to the historical composition of the S&P 100 or the OEX. So at any point in time, the mix of stocks in the index is true to the official composition. So anyway, when you look at the summary stats, you can see the first column is the strategy and the second column is the S&P 500 benchmark. The strategy has an annualized return of 21%, whereas the benchmark over that same time frame has an annualized return of 8.3. And the drawdown of the strategy is negative 22% peak to valley, whereas the benchmark S&P 500 is negative 57%. So we're producing much better return with less than half the drawdown of the S&P 500 buy and hold index. And it should be noted that the max drawdown number is based on daily P&L, not end of month P&L. So this is a more severe measurement of peak to valley drawdown, and more representative of what one might expect if actually trading it. Looking at the correlation table, you see that the correlation is 0.65 between the strategy and the benchmark S&P. It's a bit high, but that's to be expected of long-only stock picking strategies. And because the equity indexes are upward sloping over the long term, a positive correlation to that is not really a bad thing. And the drawdowns of the strategy and the benchmark are 31% correlated. So here I just wanted to show you the underwater graph of the benchmark S&P 500 versus the one for the weekly reversion strategy. So this is a S&P 500 underwater graph, or in other words, the drawdown graph, going all the way back to 1994. So you can see that it's got some pretty difficult years where these drawdowns are pretty wide and pretty deep. So for example, in 2002, late 2002, this big drawdown bottomed. That was the drawdown that happened during the dot-com bubble. Started in 2000 and kept going. That one was around 50% from peak to valley, and then it took many years to recover, and it finally recovered in 2007, only to go back into another really bad drawdown from the great financial collapse. And that one was around 57% deep, and that took quite a while to recover as well. It was well into 2013 until it hit a new high. So that's the reality of buy and hold investing. Everything looks fine when things are going well, but people tend to forget that these kinds of drawdowns can and will happen at some point, and it can last years. So contrast that with the underwater graph of the weekly reversion strategy. You can see that this is much more risk controlled, and you don't have any drawdowns that last extremely long like you saw for the index. And the depth of the drawdowns are also much shallower. So here in 1998 we had a 21% roughly peak to valley, another similar one in late 98. And then, throughout the years we've seen drawdowns typically in the range of maybe 10, 11, 12%. So overall you can see that using an actively managed timing system can lead to vastly better outcomes in terms of risk. Here we have the annual and monthly return table for the strategy. The column titled total is the year-to-year return of the strategy, and the column titled S&P 500 are the annual returns of the index. What you can notice from here is that the annual returns of the strategy are definitely much more consistent than that of the index. For example, if you look at the index return in 2008, it was down 38%, whereas the strategy was up 3%. And during the dot-com collapse year 2000, strategy was down 10%, or the index was down 10%, and the strategy was up 73. And the next 2 years after that, the index was down both years, -13, -23. The strategy made money those years as well. But it should be also noted that, just to temper expectations of subscribers, that this strategy can occasionally have low single-digit positive years and potentially even a negative year, such as what you see here in 2010. It was down 6% when the index was up 13%. So while it may not perform over maybe a 12-month period once in a while, consistently applying this strategy over the long term, let's say 3 to 5 years, it's most likely that one will realize a competitive market beating return. Of course, past performance is no guarantee of future results, but in the backtest you saw that the long-term annualized performance is around 20%, whereas for the index it's 8%. So you can get pretty good returns if applied consistently over some time frame, for minimal effort, just once a week trading. So how do you implement this? The weekly model allocations are emailed to subscribers every Sunday night, and you place the trades in your account to match the model at Monday's opening, and all the positions are closed at Friday's close. And the process was designed with ease of implementation in mind, and one should expect to spend about 10 minutes per week for both entering and exiting positions. Here's an example of some information that will be contained on the Sunday night emails. It's very basic. It shows you the ticker symbol and the percent allocation to each stock. However, everyone has a different account size, and someone may not really want to go out there and calculate percentages. So I've made this small spreadsheet, Excel spreadsheet, available on my website at that URL listed here. It's also listed in the description box below the video. It's just a sheet where you input the yellow fields. You put in your account value or your allocation preference in the yellow box where it says dollars. Input your tickers and the allocations as would be listed in the email, and put in the last price that you see for each stock. And the last column is the output. It just says number of shares you've got to buy. In summary, this strategy aims to beat the benchmark S&P 500 over the long term with a fraction of the drawdown and volatility. And it allows us to do so with minimal time investment. All it takes is typically about 10 minutes a week to reposition your portfolio. So if you'd like to become a subscriber and get weekly model updates into your inbox, please visit us at returnstream.com/weekly-reversion-strategy. I will also be pasting this link into the description box. Thank you very much for listening to this presentation.